Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Michael Normyle, U.S. economist at Nasdaq, to discuss first half of 2023 asset performance. We'll also take a look at some inflation data as well. Michael, it's great to see you as always. Welcome back to Trade Talks. And if we take a look at the Nasdaq Composite, right? I mean, what a different story we were telling in 2022 relative to how the first half played out this year.
Exactly. So the Nasdaq Composite had its best first half in 40 years. And that came after last year, like you were talking about, where it was the worst first half on record. And so that's, and it's not restricted to just the Nasdaq Composite, but now we've seen Nasdaq Composite and S&P both enter bull markets after a strong start to the year here.
And if we take a look at the market overall more holistically, what was asset class performance like?
It was basically the pattern that we saw with the Nasdaq Composite is true for a lot of asset classes. Last year, there were broad-based losses as the rate hike cycles got underway around the world. And so we had a lot of people expecting recession. So there was some sell-offs related to that. But this year, we've seen the economy prove pretty resilient. And so those sell-offs last year looked like they might have been overdone. And so we see a lot of last year's losses being reversed this year. And in the US, a lot of the headlines in recent months have been about mega cap stocks where, Apple hit a $3 trillion market cap. Other big tech stocks saw big gains where they were boosted by AI optimism. But even small caps have seen pretty good gains at over 7% so far to start this year. And even REITs are up despite the banking turmoil where a lot of people were expecting, losses in the value of offices, for example, to be a drag on the sector. But REITs are pretty diverse. It's not all offices. You've got other things like apartments, data centers, storage, all sorts of things. So even REITs are up over 2%. For treasuries, it's been an up and down year, though. We had kind of the higher for longer rates priced in earlier in the year, but then with the banking turmoil back in March, that was kind of reversed a bit. But as the banking sector stabilized, they've come back. So the 10-year, it's pretty much back to where it started the year right now at about 3.9%, and 2-year treasury yields are about 45 basis points higher at 4.9%. The other area of weakness has been commodities, and that's related to last year. We saw the spike from the war in Ukraine pushing up food and energy prices, and so those have kind of been taken care of in the last year plus. And then there's also been manufacturing slowdowns in the U.S. and China that's weighed on industrial commodities. So commodities has been more of a laggard to start this year.
Let's talk about the S&P 500 for a moment here. Where did the gains come from? And then, of course, we have to think about valuation at this point.
Right. So if you look at kind of the breakdown of the total return, a lot of the start of this year, it's been multiple expansion. So optimistic investors are willing to pay more for future profits, and they might be kind of looking forward to the economy picking up steam here. Some of it is also, at least in Q2, from improved earnings estimates. But getting to valuations, even with like mega cap that we talked about earlier doing so well, their valuations are still well below where they were at their 2020 peak. And the rest of the S&P 500, their valuations are pretty close to recent lows. So that could help support the rally if it's broadening out into the second half.
And to wrap up here, let's take a look at some inflation data because some of it was quite good.
Right. So I think the one area that we have to worry about as a potential headwind for the second half is the higher for longer rates picture. The Fed minutes just came out and basically told us what they've been saying again, that they're looking to resume rate hikes. But then on Friday, we got PCE data that came in pretty solid. So headline PCE inflation fell to 3.8% in year-over-year terms. And that's actually the Fed's target. I know CPI gets a lot of the headlines, but what the Fed bases its 2% target on is the PCE inflation. Still, core PCE only fell 0.1 percentage points to 4.6% year over year. So that's pretty high, and it's been more or less moving sideways since December. But core services ex housing saw the smallest monthly gain since last July, and it's clearly been trending lower. And that's really positive here because that's been one of the Fed's main concerns, since that's mostly a wage-driven component and it can be pretty sticky. But with that clearly trending lower, that should hopefully, if it continues, help bring core inflation down lower. And that might help explain why markets are pricing in one more rate hike, whereas the Fed is talking about two still. So markets are a bit more optimistic about the trajectory of inflation than the Fed is at this moment.
All right, Mike, we'll appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.